Is it done? Yeah. Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen. I'm privileged to be the Peterson Institute's president and to welcome you back, to those of you live here in the Bergston Conference Center, where we are sitting under the watchful eye of the Institute's founding director, Fred Bergston. This is our traditional sort of kickoff to what we used to call Macro Week, and which has become Mega Macro Week, but not MAGA Macro Week. We are very excited today to be continuing our long-standing practice of semi-annually updating our global economic prospects, which is led, as it has been since late 2017, by Professor Karen Dynan. We, as you know, and those of you tuning in, I hope are learning, every 6 months ahead of the IMF's release of their World Economic Outlook, we do our own. We don't quite have the staff resources of the IMF, let alone the large investment banks and other international organizations. But beyond our team's brilliance and insights, we also have the ability to focus and make politically objective calls that some other institutions are constrained from doing. And so we hope that we add a useful point of reference, of rethinking occasionally, and of discussion as everyone considers the global economic outlook, particularly heading into the spring and then the annual IMF and World Bank meetings. I want to give a particular shout out to Karen and a little bit to myself that we were out there repeatedly over the last 2 years telling everyone that there was not going to be, or it was extremely unlikely, and then not going to be a US recession. We were out there telling everyone that the Fed was going to raise rates faster and hold them longer and cut rates more slowly than the consensus was running away with. And we were out there with additional calls, like the fact that a couple of years ago, I told you all that SVB Bank and the rest of them were not going to be a major issue for the US economy. We've obviously gotten some things wrong. One in particular that I am very happy we got wrong is, I think Karen less so than I, overestimated the amount of unemployment that we expected to see with the disinflation. And I, for one, and I know Karen, for two, is very glad to have been wrong about that. But with that little bit of credit taking, let me just mention what we're covering today. As usual, Karen will present the global outlook, meaning the real year-over-year growth rate projections for the next couple of years for the G20 major economies. This will be followed by two topical, more focused presentations by colleagues here at the Peterson Institute. Speaking first will be, Maury, you're first, or no, Tianlei, that's what I thought. I got the wrong thing here, sorry. Speaking first after Karen will be Tianlei Huang, who I'll introduce more properly in a moment, and he's going to be discussing China's fiscal policy amid the property crisis, and in particular, how that affects prospects for Chinese growth and stability going forward. This will be followed by Maury Obstfeld, who many of you know well, and I'm looking forward to your getting to know Tianlei better. But Maury will be speaking about the role of the dollar and recent challenges and ongoing tensions in the international monetary system, building on work that he and Doug Irwin did on their floating exchange rates at 50 conference and forthcoming volume. This is all on the record, being live streamed. We will take questions at the end. But I just want to remind you, when I talk about Macro Week, just so you remember, tomorrow we will be having a discussion with Martin Grunberg, chair of the FDIC, and Tobias Adrian, the head of the Monetary and Capital Markets Department at the IMF, along with our own Nicholas Verrone and Anna Gelpern and others, about finally, supposedly, fixing too big to fail, resolving systemically important banks. We will be hosting the scene setter speech by Jay Shambaugh, the U.S. Undersecretary of the Treasury for International Affairs, on a U.S. vision for global debt and development finance. And that'll be hosted by our board member, former U.S. Cabinet official Peter Orszag, this Thursday. Next Tuesday, I have the privilege of a on-the-record chat with Ngozi Okonjo-Iweala, the Director General of the WTO, as she starts talking about the 30th anniversary of the WTO since the Marrakesh signing and what lies ahead and what has been accomplished. We are doing a couple events co-hosted with the Council on Foreign Relations, a longtime partner organization that obviously also has some useful real estate near the bank and the fund, and on issues at the intersection of geopolitics and economics, including one on emerging markets with the governors of the Central Bank of South Africa and of Turkey on Tuesday, April 16th, as well as a meeting with Christine Lagarde of the European Central Bank, hosted by Michael Froman, the president of the CFR, as well as a special session on Ukraine reconstruction on Friday, April 19th, with Nadia Calvino, the head of the European Investment Bank, and Odile Renaud-Basso, head of the EBRD. Here in the Bergston Center at Peterson, the main upcoming events include an event co-led by Maury Obstfeld with Petya Topolov and Pierre-Olivier Gorinchas of the IMF. This is the latest in our biannual rethinking conferences that started under Olivier Blanchard at the fund and then moved to Peterson, and this year we're doing it jointly again. Rethinking economic policy, steering structural change. It's already sold out, but so you should watch it online and read the papers and get excited. And we are also having a couple special monetary policy sessions, including a joint event with CEPR on monetary policy responses to post-pandemic inflation. Angel Ubide of Citadel, formerly of Peterson, Bill English of Yale, and Kristen Forbes of MIT all led a project, and the leadoff speaker, among many other distinguished folks, will be our own Olivier Blanchard. And finally, but not quite, next Friday is Central Bank Central here at Peterson. Augustin Karstens, the managing director of, that's not his right title, general manager of the Bank for International Settlements, as well as Joachim Nagel, the president of Deutsche Bundesbank, Roberto Campos Neto, president of Central Bank of Brazil, and Chang Young Ri, the governor of the Bank of Korea, will all be here for a discussion of the future financial system. And to close out the week, my old friend Kazuo Ueda, the governor of the Bank of Japan, and he will talk, I will ask questions about the recent changes in the Bank of Japan's monetary policy framework. So, having now bought time for Karen, Tianlei, and Maury to eat, and telling you all that this is indeed the place to be from here for the next 2 weeks, let me properly introduce our speakers. So leading off will be Karen Dynan, who has been a non-resident senior fellow at the Peterson Institute since March of 2017, when she stepped down as Assistant Secretary of the Treasury for Economic Policy and Chief Economist. She previously had been Vice President Co-Director of Economic Studies at the Brookings Institution and on the staff of the Federal Reserve Board, and she is, of course, now a professor of the practice at Harvard University's Economics Department. She will be followed by Tianlei Huang, who is a research fellow and also coordinates the China program here at the Peterson Institute. Tianlei's been promoted twice and is up for future greatness. He joined the Institute initially as a research analyst working with Nicholas Lardy on China economic issues, and since has started publishing very well in his own name in Independent Right, as well as co-authoring with Nick, and notably recently with Nicolas Ferron on their important tracker of private sector versus public sector ownership in China. Tianlei is going to be speaking, as mentioned, on fiscal constraints and administrative actions in China and how they constrain or shape the coming Chinese outlook. He has a recent working paper published a couple weeks ago by the Peterson Institute on that topic, which I encourage you all to read. And then finally, Morris Obstfeld, who needs no introduction, who is the C. Fred Bergston Senior Fellow at the Institute, has been affiliated with the Institute actually now for 5 years, which I'm delighted and proud to say, although he's only recently joined us full-time. He is now the class of 1958 Professor of Economics Emeritus, as well as former chair of the Department of Economics at the University of California at Berkeley. Obviously, he is an incredibly distinguished academic career, but also served as chief economist and economic counselor, director of the research department at the IMF, and as a member of President Obama's Council of Economic Advisors. So that's my speed talking. I promise to be quiet, and let me turn it over to Karen from here. Thank you.
Thanks, Adam. It's great to be here for the start of Mega Macro Week. So let me talk about the global outlook. The really good piece of news globally is that inflation has come down quite a bit from its peaks in 2022 and 2023, but for most countries it does remain some distance above central bank's target. And you can see that's true here in this slide. For the United States, I know the CPI has some upward bias, but I'll show you later in the presentation this is true for the Fed's preferred PCE inflation measure. And you can see this is true for CPI inflation for other advanced economies and for emerging market economies. So this leaves central banks watching and waiting. And while they're doing so, interest rates remain high. I've got central bank policy rates on the left here. You can also see that long-term government interest rates also remain high. Even so, stock prices are up. This is interesting. You can see on the left stock price indexes for various advanced economies. You can see they're up quite a bit for some of the countries. And what this means is that broader financial conditions, they're not as tight as one might expect based on moves in interest rates alone. So in fact, I have the Federal Reserve's financial conditions index for the United States here on the right, and you can see there that basically financial conditions have moved much further back towards normal. And this shows up in similar global indexes of financial conditions. And I will say that's partly because of how high stock prices are. It's also kind of other factors in the index, like tight corporate spreads right now. So anyway, all told, my global forecast calls for fairly steady real GDP growth, real GDP rising at a little over 3% this year and next year. I will say that the steadiness in global output, it masks substantial differences across countries. And I'll come to that in a minute, but there's lots of talk about divergence right now. I also want to note that this projected pace of global growth, it's a solid pace. It's not particularly strong. It's held back in part by slow growth in many developing economies who are struggling. I'm not going to say a lot about them, but I do want to kind of just kind of make that note that this is slower growth than, for example, we saw in parts of the 2010s. Okay, so just some country-by-country detail. The G7 economies, they're mostly seeing soft-ish landings to varying degrees. So what I mean here is disinflation without recessions. So the way I've set up this chart, the lighter blue lines, those are my forecasts for 2024 and 2025. The navy blue line, the darkest line, that's history. That's the 2023 numbers. But I also stuck in gray, the first bar, the average growth in 2017 through 2019. And I did that so you had a kind of a benchmark for normal times for these economies. But anyway, you can see here that the US is experiencing robust growth. It has experienced robust growth, even with some disinflation. And that's because of a combination of favorable demand and supply factors. I'm going to talk about them in more detail in a moment, but I do expect growth to moderate some next year. Okay, The euro area is showing much less economic momentum than the United States. Europe has been buffeted by high inflation. That's been exacerbated by energy shocks related to Russia's invasion of Ukraine. So growth rates there are much slower, but I do expect that growth is going to pick up in Europe once monetary easing kicks in. Okay. Japan, it had a terrific 2023 as a whole. That's because in the first half of 2023, we saw this real surge in tourism in Japan. However, the effects of that have been overtaken at this point by some external drag coming from slower growth in in Japan's trading partners, including China, as well as rising rates. So I expect slower growth than in 2023 in Japan. And then the UK, it's kind of still just muddling along. I think kind of when all is said and done, there may be a technical recession in the second half of last year. But basically, you can think of the UK as moving sideways, at least through this year. They're just struggling with fiscal limits, real income declines. They've got a lingering Brexit drag. So I think we're going to see this kind of sideways movement until things pick up with lower interest rates there. Now, here are the major emerging market economies. Here the story is really kind of different drivers of growth. This is really where you see the divergent stories that are shaping each economy's prospects. So China, notwithstanding its real estate crisis last year, it actually did pretty well in 2023. And that was partly base effects, a rebound from a weak 2022. It was also resilience in consumer spending and in private investment. However, and Tianlei is going to talk about this more, I think the resilience in the consumer sector is going to fade there, and it's going to be only partially replaced by state-led investment. India's the real standout in this group. They've really benefited from domestic reforms. They're having inflows of foreign investment from friendshoring. And so you can see I have robust growth rates for India. And then Russia's done better than a lot of people expected. The story there is the combination of pre-war surpluses and ongoing energy demand. That's really put a floor under Russian growth. And then the last economy I have here is Brazil. So Brazil gets really good marks for its macro policy. It did a great job with inflation. At the same time, it has structural issues that are kind of weighing against the macro policy. So it leaves Brazil's growth rates only moderate, so certainly kind of much slower than they were in the early 2000s. Okay, so there's some numbers for people who prefer to see forecasts in tables. But let me talk now give you some details around the United States. So United States, really striking development of kind of the last half year has been surprises to the upside. And on the left here in this chart, I just plotted the level of US real GDP compared with Europe. And yeah, the two economies face some different challenges, but on the whole, there are many commonalities between them. But you can just see the US just surging ahead in the way the euro area is not. Another way to see this is on the right side of the graph, where I'm plotting the evolution of GDP growth forecasts for 2024. So the gray bars, they show you 2024 forecasts and how they evolved over the months of 2023 and early 2024. And what you can see there is that since the middle of last year, you can see just forecasts getting marked up again and again and again. You can see my global economic prospects forecast on here. I did better than consensus, but even I was not bullish enough. So anyway, what's going on here? Well, let me start with demand. And this is actually something we've been talking about for a while, which is demand is being supported by strong household fundamentals. So, first we've got kind of real income growth. So if you look at, for example, real aggregate wages and salaries are up about 7.5% since before the pandemic. But of course, what's underlying that are these really healthy labor markets. I've got non-farm payrolls from last Friday's impressive employment report on the left here. But then this real income growth combined with other factors has really shored up household balance sheets. So I've got median net worth for low and middle income families on the right here. I left the kind of top two quintiles off this graph because they just tend to distort the scale, but I assure you that what I'm showing you here for the lower and moderate income families, this is true for the higher income families as well. And what I want you to see is kind of the SCF median household net worth bars. Those are the darkest blue bars. And you can see it really pops up to the highest level in decades in 2022 relative to pre-COVID days in 2019. So you can see net worth increasing. You might ask, well, what's happened since then? You know, are households kind of now finally drawing down their excess saving? But no, if you forecast the numbers forward using the similar data from the distributional national accounts from the Fed, that's what I'm showing the hollow bars, and you can see net worth creeping up further from where it was in 2022. Okay, at the same time, you've got residential investment holding up despite mortgage rates of 6 to 7%. You can see housing starts on the left there. And also private business investment, that's held up as well, despite these higher interest rates. So I plotted here one category that's getting some attention recently. This is real investment in manufacturing structures on the right. It's the level there. You can see it shooting up. That's thanks to our industrial policy in the United States. So I wanted to kind of point that up. I will tell you, it's a small category. So even though it's doubled, you can see the contribution to GDP growth is just a 1/4 percentage point. You can see that in the inset box. You can also see in the inset box that the rest of investment is also growing on net, which is why you're getting a larger contribution to GDP when you sum it all together. Okay, so that's demand side. Where the really interesting developments are on the supply side. So this is something that is really interesting. Potential output appears to be growing more briskly than previously recognized. So I'm showing you here the upward revision to CBO's estimate of real potential US GDP between June 2023 and March 2024. So CBO has marked this up based on higher potential growth, really in the early 2020s. So for example, for 2023 to 2024, they've marked up potential output growth by 0.4 percentage points. So that's a big change in potential output growth. But this is really important because higher potential output growth, that has near-term implications for gauging appropriate monetary policy, right? Because it implies that you can sustain a higher economic growth rate without creating inflationary pressures. And of course, it has longer-term implications for fiscal sustainability. Okay, so what's underlying this? Well, the big contributor here is a surge in immigration. Here you can see the blue line is showing you CBO's current estimates through 2024 of net annual immigration to the United States, and you can see how it compares to their 2023 estimates. What CBO did was they looked at records from the Department of Homeland Security and other sources, and basically kind of realized that there were many more immigrants crossing our southern border than had been understood, looking at some of the more traditional forces. So they had 6 million more people in the early 2020s than coming in than previously thought. So that's going to create a much larger labor supply in the United States. Now, I will say, we don't know how much longer this immigration surge will continue. It depends in large part on changes in policy by both this administration and the next. I want to say also that potential output has been bolstered by robust labor force participation. So I've got prime age labor force participation on this slide. You can see it's at its highest level in decades. People are being drawn in by the strong labor market in the United States. Even overall labor force participation, which I'm not showing, but it's nearly back to its pre-COVID level. It's about 0.5 percentage point shy. But that's very striking, given a material drag from population aging and some drag from long COVID. So as long as I'm talking about potential output, I don't want to close without mentioning what's going on with productivity growth. So productivity, this is something we should be paying more attention to. It's really hard to capture these changes in trends. My reading of the best science right now so far is that there's no apparent or no detectable change in trend. I've got a simple version of that in the graph I'm showing here. You can just see that if you plot the 2004 to 2019 trend forward over the last couple of years, you get kind of the final level is pretty close to where we are now with the level of productivity. There is a hint at a possible acceleration over the last few quarters. And I think this is actually quite interesting because sometimes when you see these sorts of accelerations, it's in periods of slow labor force supply growth, but this has been a period of fast labor source supply growth. We don't really know what's going on there. I'm skeptical that it's an AI story yet. I think it's more likely to be related to something like higher business dynamism or something that Adam's been thinking a bunch about recently, which is just the pre-COVID reorganization of the labor supply kind of created kind of a better match for many workers in terms of the jobs that they have. As I said earlier, this higher potential output growth, it does allow for our economy to grow faster without creating inflationary pressures. That said, when I look at the details of our inflation numbers, I don't think this stronger potential output growth is enough to allow the Fed to kind of relax at this point and start cutting interest rates. So here I've picked apart basically the components of core PCE inflation. This is the Fed's preferred measure. I'm highlighting the 6-month change because I think that's the change that has kind of the right combination of noise and of less noise and more timeliness to be able to kind of see the turning points. And this is what the Fed, I think, is focusing on now as well. And what you can see is that the process of disinflation, it looks to have stalled. Maybe it's reversing a little bit. And I know kind of there are probably a bunch of you out there saying, oh, but I know a special story as to kind of why this reversal is just temporary and inflation is going to start coming down. I hope that's right, but I feel like it's been a number of months now that we're telling ourselves all these special stories, and that you really can't count on all the special stories working out well at once. So I think this should be giving people pause, and I think this means the Fed's going to lower rates kind of more slowly than currently expected. In my forecast, I have just one rate cut in there for 2024. To come back to my earlier theme, I think the Fed is going to be mostly watching and waiting this year. I do think that will be enough to kind of slow the economy down such that we will see a more convincing disinflation. We'll see disinflation resume in a more convincing way, and then we'll see the pace of cuts stepping up more next year. I will comment that asset prices, they've held up so far, despite markets repricing to slower rate cuts, but that may not be sustainable. So we may see asset prices as investors come to understand that the Fed is not going to be cutting as fast. We may see asset prices fall, which would also help take the edge off of demand. Okay, so just my final slide. These are the details of my forecast. Basically, I think, as I said, I think economic momentum is going to be slowing down. I think the strong growth is mostly in the rear view mirror at this point, which is why, as you can see for 2024, my year-over-year GDP growth numbers are much stronger than the growth rate over the 4 quarters of 2024. And that's just because we've got kind of the economy slowing down to a more sustainable pace from here, and then kind of a further slowing in 2025. The unemployment rate, because of this slower growth, and it's below my estimate of potential right now, the unemployment rate comes up a bit, about a 1/4 percentage point, and that's enough to see inflation coming down closer to the Fed's target this year and again next year. I will just say as a closing note, this is a soft landing forecast, and I'm optimistic we're going to get it, but I will say I do think recession risk is still somewhat elevated, both for the United States and for other major economies, given geopolitical uncertainties, including the upcoming election in the United States this year, as well as the potential for more inflationary supply shocks, a heightened likelihood of asset price corrections. So that's it. Thank you for listening, and I'm going to turn things over now to Tianlei.
Okay. Well, good afternoon, everybody. First of all, let me just say that I'm hugely honored to join Adam, Karen, and Maury today. Their research has inspired so many of us, so I'm very grateful to have this opportunity to share the stage with them today. Thank you very much for having me. I'm going to talk about China's outlook and, in particular, its fiscal policy amid the property crisis. Here are the main takeaways in my talk. Since China announced its growth target last month, many observers, including myself, have been questioning whether they'll be able to achieve that target, because the one-off boost from its COVID reopening is obviously gone, and the housing downturn will continue to drag on economic activity, and the policy that has been announced so far still seems modest. But from Beijing's perspective, making such a relatively ambitious target is necessary to create enough jobs and also to help get its economy back on track to achieve the GDP doubling goal by 2035. It's of course also meant to send a signal to try to revive business confidence, which has very much been lacking. Given China has really missed its growth target in the past 3 decades, I think we will see more policy support in coming months, especially in those priority areas now identified as new productive forces. We just see that the PBOC yesterday announced a new relanding facility targeted at technology firms, and I think more such easing may be coming. This year's policy has a clear focus on producers rather than consumers, and the public sector, not the private sector, will play a pivotal role in driving growth. This will inevitably, I think, exacerbate the structural imbalances in the economy and lead to a greater role of the state in the economy. If this policy bias against consumers continues, I think it could undermine China's efforts to pursue the so-called high-quality growth. Let's first look at consumption. Household consumption was the main growth driver last year. It grew at 9% in real terms, which was supported by 6% real growth in disposable income. But that strong growth was in large part due to recovery, and in my view, it's unlikely to sustain. Private consumption this year will be more uncertain. Ever since consumer confidence in China dropped to historically low levels since the zero-COVID lockdowns in 2022, it has stayed at that low levels up until now. And the property crisis is obviously an important factor behind it, simply because housing is such an important part of household wealth in China. But this factor didn't really have a chance to show up in consumption data last year because, again, recovery was the main dominant factor, but it could play a more visible role in affecting consumer spending this year. That said, the housing downturn can also affect private consumption in a positive way. When housing prices go down, people may consume more goods and services not related to housing, as they feel like they don't need to save that much for housing anymore. And housing speculative demand would also transform into easier consumption or savings. Some call this the substitution effect. Therefore, private consumption in 2024 depends on which factor will play a more dominant role. Is it the negative wealth effect or this substitution effect? In terms of net export, just briefly, last year net export dragged down GDP growth by 0.6 percentage points, but this year it will likely make a small positive contribution to growth, since external demand for Chinese goods will likely see some modest recovery. Investment played a relatively small role in driving growth last year. Growth in investment was entirely driven by state-led investment, as private investment saw a slight contraction for the first time in decades because of the contraction in real estate development investment. Interestingly, private investment outside of real estate grew strongly at 9% last year, which can be mostly attributed to a strong growth in manufacturing investment. For this year, I think private investment will continue to remain weak. Strong growth in manufacturing investment will probably fade because of excess capacity and falling prices and profits in many sectors. And in the meantime, real estate investment will continue to shrink. On the other hand, state-led investment will continue to grow strongly and play a more prominent role than last year in driving economic growth. And the importance of state-led investment in driving growth is reflected in China's 2024 government budget. The drop in this year's budget deficit ratio to 3% of GDP got many people confused, but actually China's budget this year is slightly more expansionary than last year's actual expenditures. As I'm showing on this slide, both planned spending and deficits in the four budgets combined, measured as a share of GDP, are higher than last year. If this year's budget is fully expended, then fiscal spending as a share of GDP will go up for the first time since 2020. This year's budget has a strong focus on government-led investment. More than 50% of the increase in overall budget spending this year will be used on investment, mostly by local governments, which will help absorb some of those industrial overcapacity and help alleviate some deflationary pressure. What's noteworthy is that the central government is also going to undertake some investment on its own this year using the special treasury bond issues, which is rather unusual. It seems to suggest a gradual shift toward a bigger investment role by the central government is now underway. Now that the budget is more expansionary, a big question is whether this budget will be fully spent. In the past several years, local government's actual spending has repeatedly fallen short of the budget levels. The same factors will probably lead to actual spending falling short again this year. The first potential drag is local governments may not use up all the new special bond quotas. This underutilization of local special bond has been a repeated problem since COVID. My own estimate shows that at least 13% of all local special bonds issued in the past 4 years were left unused. And this is to a large extent because of the central government's requirement that these bonds can only be used in projects that can generate sufficient returns to cover interest payments of the bond issues. But many localities simply cannot find enough eligible projects, partly because they had already overinvested in infrastructure, in particular in previous decades. This problem may well continue this year. Second, this year's budget makes an overly optimistic projection of land sale revenue. But given there is still considerable uncertainty in the housing sector, local governments may well see their land revenue continue to shrink this year. If that happens, spending will fall short unless the government can draw additional revenue from elsewhere or issue more debt. Moreover, if we look beyond the formal fiscal system, local governments also run many financing vehicles that make public investments, and through those vehicles, they have accumulated massive off-budget debt. Beijing has now launched a campaign to restructure those off-budget debts through measures like allowing some regions to issue refinancing bonds to replace these debts with formal government bonds. And some local investment projects have also been suspended during this process. But that campaign so far is concentrated in just a dozen provinces facing the most severe debt burden. And the tightening in off-budget spending in those regions as a result of this campaign is more than offset by this year's on-budget fiscal expansion. However, if this campaign intensifies and spills over to more regions, it could lead to a further retrenchment in off-budget spending, undermining the effect of this year's on-budget fiscal expansion. If in coming months any of those drags does materialize, Beijing will need to be prepared to adjust its budget, just like what it did in October last year, to avoid its intended fiscal boost falling short. Let me stop here. Thank you very much.
Okay. Good afternoon, everyone. I'm going to talk today about exchange rate experience over the last 50 years. This is partly occasioned by a Peterson book that we have just brought out. And one of the striking aspects of today is how much it echoes considerations 50 years ago at a very dramatic time in international monetary and indeed geopolitical history. In the early 1970s, the Bretton Woods system, the system that had governed post-war recovery and growth, unraveled. And by early 1973, major currencies were floating against the dollar. This was viewed at the time as a temporary strategic tactical retreat, but it has continued to this day. Inflation was rampant globally. The Middle East exploded. OPEC reacted with an oil price increase, and many of the implications of OPEC's action remain with us to this day. In 1971, President Nixon unilaterally severed the link between the dollar and gold that was one of the cornerstones of the Bretton Woods system. He imposed 10% across the board tariffs, sound familiar? And for many, this signaled a regime change, with the US turning more inward, if you want, adopting more of an America First attitude. But a durable non-system emerged, and things did not turn out quite so grimly as might have been expected at that time. The new Peterson book, which I've edited with Doug Irwin, grew out of a conference we held here last March to retrospectively look at the floating exchange rate experience as it has evolved, not only covering advanced economies, but also bringing in emerging markets over these 5 decades. As I said, a non-system emerged. This is a term that was also actually coined by our late colleague, John Williamson, and it has evolved considerably. We have 29 essays, and I think the book did a good job of comprehensively analyzing what's happened in money and financial markets and the impact on the world economy in the last half century. A number of authors speculate on the future of the dollar in the international monetary system. I'll come back to that at the end. What are some of the themes? Well, one major theme is that financial shocks are main drivers of short-run exchange rate movements. This is not something that was really widely anticipated in 1973, but in fact, a massive expansion of global financial markets occurred since the 1970s. This allows for liquidity, diversification. It has benefits, but it is also a source of shocks, especially for emerging markets. A second major theme is about politics, which pervade the functioning of the system to no one's surprise. One of the presumed benefits of exchange rate flexibility is that it would allow monetary autonomy for countries. This also makes countries' policies more responsive, of course, to domestic politics. And furthermore, even freely floating exchange rates don't provide full insulation. So countries become vulnerable to macro developments and indeed political developments abroad. Flexible exchange rates don't offset the effects of trade and technology in driving sectoral change, something else that has riven our politics in recent decades. And the interdependence among countries creates the need for international cooperation, even with monetary autonomy and flexible exchange rates. In fact, this has continued, which perhaps would have surprised many observers 50 years ago. But if you look at institutions like the Basel process, Fed and other central bank swap facilities, or events like the Plaza Accord, it's clear that international coordination continues. Many problems of the Bretton Woods system also continued because it turns out they're not all inherent in the way that system was structured. They're inherent in some sense in the nature of international trade and finance. So to take a few of these current accounts, it was hoped that with flexible exchange rates would adjust quickly to limit the extent of global imbalances. But as you can see on the left-hand chart, which looks at world global imbalances, and this is the non-dashed line, these expanded considerably over the past half century. For the US on the right-hand side, the deficit has gone up and down and up and down, but it remains quite hefty. One of the reasons for this is that the growth of international financial markets, while being a source of shocks, has also greased the wheels of international finance. It has made deficits and surpluses easier to finance in general. And we saw that in particular, going to the right-hand side, in the US during the first decade of this millennium, when foreign inflows helped finance the domestic housing bubble an experience that ended in tears. The dashed lines in these charts indicate the magnitude of financial flows, which is way more than what you need to simply finance current account deficits. Again, this indicates the vulnerability to financial shocks and the vulnerability to financial instability that has certainly risen since the Bretton Woods period. Staying on the topic of imbalances in exchange rates, there's been a lot of variability, even long-term, in exchange rates. And while early proponents of floating exchange rates thought that exchange rates would adjust mainly to eliminate global imbalances or export deficits, export surpluses, that has really not been the case. And if you look at this history of the dollar since 1973, it's very hard to discern without further analysis the role of U.S. deficits. For example, over the early 2000s, a period when the U.S. deficit rose as a percent of GDP to the unprecedented level of close to 6%, the dollar dropped like a stone. And this is not what would have been predicted necessarily by a theory in which a depreciating exchange rate rapidly eliminates a current account deficit. Part of the issue here is simply that we probably underestimate the role of spending as opposed to relative prices in the way the current account evolves over time. And this is a lesson that I think we'll be talking about over the next few years as well. There was a concern by the founders of the Bretton Woods system that a system of floating exchange rates would lead to widespread protection and discourage the growth of trade. But if anything, the outcome has been, at least until very recently, the opposite. As you can see in this chart, world trade grew tremendously over the period starting in the mid to late 1980s. It also grew relative to its level in 1970, but it really accelerated during the period of hyperglobalization in the 90s and 2000s. And in fact, until very recently, protectionist pressures were fairly limited. In fact, in the first 20 years of the floating rate period, we saw ongoing trade liberalization and the formation of the WTO. Only recently, since the financial crisis, has the growth of world trade fallen to be more or less at the level of the growth of world GDP. A final point that I think is of interest is about the behavior of global inflation. Of course, when the dollar was untethered and other currencies were untethered in the early 1970s, inflation was a huge problem. And there were critics who feared that delinking currencies from the gold anchor would lead to a collapse of discipline and even more inflation. And indeed, if you look at what happened in many emerging markets in the early years, the 70s, the 80s, there were many cases of very high inflation, some of hyperinflation. But lo and behold, over time, and here, this is the big picture of inflation, so it doesn't really focus so much on the recent period, although the recent period, I think, supports this claim because emerging markets have been quite successful in their responses to recent inflation. There's been a convergence of inflation to single-digit levels everywhere, which is really quite remarkable. This has been accompanied by a move of ever more emerging markets to floating rates, to stronger frameworks for monetary policy, to more skillful monetary management, institutional strengthening of central banks. And the outcome has been pretty remarkable in terms of global price stability. So while we may agonize over whether core inflation in the U.S. is 3% or 2%, relative to past experience, we're in a good place. There's a last mile to worry about, but expectations globally have remained pretty firmly anchored, and that's a great success story. What about the dollar's role in the system? The dollar was central to the Bretton Woods system. You might have argued or thought that when the system collapsed, the dollar would become less central. There'd be more symmetry among countries, but this has not really been the case. The dollar maintains a huge role, and Fed monetary policy maintains a huge role in influencing macro outcomes and financial conditions worldwide. And on standard metrics, the dollar's role is overwhelmingly strong. I show on this slide some data put together by Carol Berthaud and co-authors at the board. On the left, you see the share of dollar invoicing outside of the euro area. It is remarkable how dollar invoicing dominates global trade. On the right is the share of dollars in international reserves. And even though some currencies have grown, the largest increases are not really for the Chinese yuan. Instead, what is reflected here, many scholars believe, is just the growing sophistication of central bank reserve managers who want to diversify a bit out of dollars to maximize returns. But the dollar's share in global reserves remains very high. So is the US dollar's reign ending? Does this snapshot represent a last hurrah for the dollar on a declining path? I think to answer this, we should ask why the dollar did not lose its primacy after the Bretton Woods period. And it was due to several factors that I think remain strong. First of all, the conquest of US inflation by Paul Volcker played a huge role in shoring up the dollar's position. And I think that conquest of inflation has now largely been reaffirmed. Financial liberalization and the US position of financial primacy, I think, also played a huge role. US financial markets were unparalleled. Network externalities, and in fact, the need for a global benchmark currency. Just as we need a currency in domestic transactions, in global transactions, we need a sort of numeraire currency, a medium of exchange and store of value. US dollar has played this role effectively. The US rule of law, its political stability, these may not be givens, but so far they've been positive. And then alternatives. If you don't want the dollar, what do you want? And the alternatives don't look that plausible, even the euro. So most of the authors in our volume felt that, at least in the medium term, the dollar would remain in its central positions. And many felt, or at least I feel, that even the threat from digital currencies is quite overhyped. Now, of course, the world is dynamic. We should be ready to be surprised, especially looking at events of the last few years. Continuing trade and geopolitical frictions leading to even more weaponization of the dollar and perhaps other currencies, and financial segmentation could change the picture here. In my view, the most likely outcome would be rival currency blocks, with the dollar zone probably remaining the major currency bloc representing the largest share of global GDP. But we could see countries in the global south participating in more than one currency bloc. And this would be a situation in which current fragmentation is accentuated because, in fact, we do need a global currency to maintain the sort of frictionless trade that we've enjoyed for the last few decades.
My thanks on behalf of all of us to Maury, Tianlei, and Karen for 3 excellent presentations. I'm going to do a lightning round of quick follow-up questions to each of you, and then we'll turn to the audience. First, Karen, among the various things you talked about, you did not invoke the dreaded concept of R star. the neutral rate that supposedly exists for monetary policy, but also seen as proxied by, say, the 10-year Treasury. This, however, has been a very lively debate in the central bank, at the Fed, in the Peterson Institute, and elsewhere, what's happening with our star. So in addition to what you said so far, could you say a bit about what you think the likely future sort of stable rate, if there is one, of our star will be? And is it driven by your upward estimate of potential growth or other factors?
Okay, so I think you're talking about long-term R-star.
Yes, long-term.
And if you were looking at my graphs really carefully, you would see where I had the path, my projected path of the policy rate starting to, or actually I have it leveling out in the end of 2025. And that was meant to, I don't have kind of the long run on that graph, so that was meant to kind of signal that that's the terminal rate. But I have it leveling out between 3.25 and 3.5. So higher R star.
3.25, 3.5 at an inflation rate at target of 2%, or?
Oh, inflation rate, yeah, so you're right, the real R star. No, so I have inflation just over 2% at that point. Right. Okay, so that's a fair point. But remember, kind of nominal R star was 2.5%, so the Fed thought before we entered this inflationary period. So I do think R star is going to be higher than it was by something like 3/4 to 1/2 percentage point. Now, kind of why? I think part of it may be a higher potential output story. We talked about kind of why that might be so on the productivity front, but then just I think that's not the biggest part of the story. I think the biggest part of the story is just higher government debt, kind of the higher levels of debt post-COVID, kind of the trajectories from here, given population aging, given kind of spending needs related to the green transition, given kind of spending needs related to kind of a more dangerous world geopolitically.
Thank you very much. Tianlei, in your presentation, you presented a lot of Chinese GDP official statistics at face value, including the growth in private sector consumption and investment. A number of private sector analysts, including people well known to us, have come out with statements over the last several months expressing a great deal of doubt about those Chinese GDP statistics. So could you say a bit more about how comfortable you are with using those statistics and what you think is real dependable versus not real dependable in the numbers?
Thank you for that question, Adam. I think it's probably useful to differentiate two issues in our thinking of Chinese data here. One is about the political motivation to manipulate data or discontinue the release of certain data series, which I think does exist, and it's a real and big concern. Let me give you an example, a fairly recent example. At some point in the second quarter last year, the statistical authorities revised downwards the historical series of both real estate investments and real estate sales, so that last year's decline in those two indicators ended up being less pronounced than what they would have been without those revisions. Well, maybe a case can be made about what they did to the investment series, because it's probably a part of their efforts to clean up the messy investment series, all investment series. But I find that what they did to the sales data a bit hard to understand. That's a harder issue to deal with. I think ultimately China probably needs a more independent statistical authority to deal with that. The other issue is about data quality in a more genuine sense. I think we shouldn't underestimate the difficulty to compile data in such a large economy like China's. Even the US, the government statisticians also sometimes have to struggle with that. That's especially the case in China. In this regard, I do see signs of efforts, at least trying to improve the data or making the Chinese data more internationally comparable. And for example, starting from probably 2 years ago, the statistical authority started to publish unemployment rate for migrant workforce separate from the broader unemployment rate, which tends to undercount the issue of unemployment in the migrant workforce. So that's a response to the many constructive feedback that economists have been giving the government. So I think a more nuanced understanding and treatment to Chinese data is needed instead of just outright rejecting or embracing everything reported by China.
Thank you, Tianlei. Maury, thanks so much for your very thematic pulling together of the work on 50 years of floating and some of the surprises you mentioned. When you talked about the role of the dollar, you didn't seem to mention fiscal deficits or current account deficits. You indirectly said current account deficits have been sticky and don't seem to move with the exchange rate. If I go back to the first 20 years of the Institute, Fred Bergston, Bill Klein, Stephen Maris, John Williamson all wrote about the mounting threat of accumulating current account deficits. Our dear cousins at the Peterson Foundation are very concerned about right now, about the trajectory of fiscal policy in the US, and Karen mentioned that as affecting interest rates. How do these factors merit a mention when you consider the role of the dollar, or are there other factors that outweigh them?
Well, I think this comes in under the macroeconomic stability criterion, which is just not only monetary policy, but also fiscal policy. And if fiscal solvency is going to be on a collision course with price stability, we don't really know what's going to give way. But I think either party, the monetary authority, the fiscal giving way, or the fiscal debt coming into question, being downgraded, are factors that would certainly hurt the dollar. I think again in the short run, the markets are willing to accept more dollar debt. And in fact, one of the kind of striking things we've seen globally is how much more debt even emerging markets seem able to support. Now, much of that evolution occurred during a low interest rate period, and I think the jury is still out on where we are now. But definitely, if we get to a point where the markets either doubt the ability of the U.S. government to meet its commitments, or doubt the steadfastness of the Fed in maintaining price stability, that would spell trouble for the dollar.
Thank you. We've run a little bit over. It's my fault for listing so many events upcoming. Maybe we'll just run that clip at 2 times speed in future. But we would like to get in a couple questions from the audience. Jessica has a microphone traveling up front. There's also a standing mic in back. Please identify yourself when asking a question. Yes.
Yes, Mr. Huang, can I just ask
Can you identify yourself,
Barry
please?
Wood, RTHK Radio in Hong Kong, and a columnist. Mr. Huang, is the United States volume of trade with China declining, as I think it did in 2023? And is it also narrowing the U.S. deficit in trade with China?
Well, I think if you look at if you look at China's net exports in general, I mean, I don't recall the U.S. number on top of my mind. If you look at net export in general, last year it actually declined a little bit from the 2022 level, and there was a drag on GDP growth. But before 2022, it was going up quite rapidly. But net export as a share of China's GDP has been below 4% for more than 10 years now. A lot of people are very worried about Chinese overcapacity. I think that's a real and big concern. You just look at prices. Prices are not only low, but they're falling. Not only those new energy products, but also those traditional sectors, right? I think at the same time, it's also unrealistic to expect China to export its way out of this current economic slowdown, as some analysts have put it. unless China's export can grow at a substantially faster rate than imports, which, by the way, won't happen just because of more export of EVs, batteries, and solar cells. Those combined are just less than 5% of Chinese overall goods exports. Otherwise, China, such a large economy like China, still has to rely on its external demand, on its domestic demand rather than external demand to drive its economic growth.
Thank you, Tianlei. Another question, comment? Yep, over here in front, Jessica. Thank you.
Thank you. My name's John Danilowitz. I'm with PepsiCo. I have a question for Tianlei as well. You've talked a little bit about, or you alluded to the Chinese consumption data. I was wondering if you could delve into a little bit about the categories within the consumption data and kind of tell the story about, so within private consumption, what does that look like? What is the Chinese market buying? What is it not? Anecdotally, last summer, I was part of an industry association discussion about the nature of Chinese consumption. And the categories were, as of last summer, it was, big capital expenses, household capital expenses, right? So things like appliances, that was very low because it's reflecting the nature of the real estate market. But other forms of personal consumption were up. So I was wondering if you could kind of speak to what are Chinese consumers buying? And is it perhaps soda and potato chips?
Well, so if you look at last year's data, obviously everything related to real estate was declining. That includes appliances, furniture, decoration, and building materials. Services were going up quite rapidly. That's actually the only, probably one of the very few bright spots. If you look at prices, services prices are going up because of the recovery in tourism and restaurant and all the services activity. Car sales were very strong last year. It was actually, I think it was, car sales last year saw the biggest increase among all kinds of categories. Of course, EV was going up very fast as well. But as a share of total car sales, I think it's still around 25-30% of the total. But it's going up very rapidly. I think going forward, like I said in my initial remarks, it will largely, I think to a large extent, depend on how the housing market will evolve. Right? Are we going to see more negative wealth effect? Last year, we didn't really have a chance to see that showing up in consumption data. But if you look at no matter what data series you look at, there are multiple that shows household expectations on future income, on jobs. They don't look very good. I think this year, this factor may play more prominently than last year in affecting consumer spending. Well, you can also make the case that if housing prices go down, like I said, people may consume more. And actually, mortgage servicing cost is also going down, and people who already own may also go out and consume more since they don't have to save that much for their mortgage payments. But I was also cautioned a little bit on that factor because housing prices in China, the corrections we have seen so far are actually quite modest, right? New homes prices have declined by something like 5% if you look at the 70 city average. Secondary markets saw more dramatic declines in prices, but that's still just 10 to 15%. So how much would those relatively modest decline in housing prices affect people's consumption behavior? I think that's something to watch.
Thank you. Sorry, one more question back there, and then that'll be the last one.
Mike Frattantoni with MBA. Question for Karen. So how are you thinking about the divergence between what the hard data is showing, which can't disagree with what you showed, and some of the more qualitative data? So, ISM, PMI indices showing stagnation, not really growth. The NFIB data out this morning showing small businesses really pretty pessimistic about the outlook. Consumer sentiment similarly down. And then also to Adam's question about China's data, U.S. data, concerns about response rates in the payroll surveys, and then just the consistent downward revisions we're seeing after preliminary releases. So both of those, if you wouldn't mind.
Yeah. Thanks, Mike. Yeah, so I'll start with your second one. The response rates are down a bunch. They're not nearly, and this is the payroll survey, we're seeing it in other surveys as well, they're not nearly as low as they are, for example, in the UK. I think, I think that issue has been I think it's been kind of overplayed because I think statisticians understand kind of, how to correct for response rates falling. The worry is always like it's going to introduce some sort of bias. When I look at the data for, say, the payroll survey or for JOLTS, I don't see a series that have become materially more noisy, even if we do have some systematic revisions over time. So kind of my sense is those kind of payroll numbers are pretty good. The softer indicators, hard to say. I think, PMIs, that's I don't know if you're talking about manufacturing or manufacturing and services. I mean, I think kind of these sorts of surveys, they can have some signal in them, but they're affected by lots of different things. And I do feel like uncertainty's building again. There's a lot of focus on the election, how that's going to change kind of policy. And I think that uncertainty alone may be kind of damping sentiment in a way that, really does reflect people's concerns. But, on the other hand, won't necessarily dampen the hard data, the spending in the economy. I mean, like I said, I think we talked about this earlier, I think there are some cracks you can see in the economy. You can see delinquency rates rising for some types of credit. But on the other hand, when I look at kind of more broadly at things like wealth and I think about excess saving, I still think there's some pretty solid, kind of fundamentals out there when you're thinking about the household sector as a whole.
Great. Well, thank you all very much. Please join me in expressing your appreciation to Karen Dynan, Tianlei Huang, and Maury Obstfeld for their presentations today. We'll look forward to seeing you all back here at the Peterson Institute repeatedly in coming weeks and months and years. Thank you.